Hello everyone. Today we'll be starting with the accounting portion of EPFO exam. Accounting generally consists of about 8 to 10 questions or about 15 questions in each EPFO exam. So it's very important from that point of view. And yet it is very easy. So it would be very easy to get those 8 to 10 or 15 questions correct in very first go. So we just need to know the very basics of few topics which have been provided. So we'll just go through them by each topic like one by one and it's all done. We just the procedure would be, first of all, we'll go through the concepts of each and every topic, and then after we'll solve the MCQs in the class itself, and then after you can revise the topics and practice some MCQs at home, and in case of any queries you can get back to me and we can sort it out together. So let's start accounting. So to know what accounting is, basically, first of all, we all should know the definition of accounting. What accounting is about, or what is all that is recorded or that is included in accounting. Accounting basically has three parts. First of all, it says recording. Second, it says classifying. And third, it says summarizing. So a question must be coming to your mind that what do we record, what do we classify, and what do we summarize, and how do we do all these things? So to give an answer to your queries, recording would be the first step in the process of accounting, and recording of all the transactions that happens on day-to-day basis. So recording would be of transactions that happens on day-to-day basis. And where do we record these? We do record these transactions in journal. And there is another option other than journal, which is subsidiary books. Don't worry, these words may sound quite unfamiliar to you all, but don't worry, we'll sort these words out and you will be able to understand what these words are about. I'm just letting you know the basic definition of accounting. All this we'll discuss in detail in the coming chapters. So, journal or account subsidiary books, recording of transactions on day-to-day basis in these journal or subsidiary books would be termed as recording. And recording in journal, there is a term which is known as journalizing. So in many of the exams, this question is generally asked, what do you mean by journalizing? So you should know what journalizing is. So recording of transactions in journal is known as journalizing. Please do write this definition in your notebooks. Recording of transactions in journal is known as journalizing, because this is a very common question which is being asked. Not just in our exam, but in many of the government exams, this type of questions are asked, so we must know the definition. So this is recording. Another step is classifying. So first of all, when we record the transactions, then we have to classify them. Classify them in what? Classify them into ledgers. And classifying these journals into ledgers is known as posting. So please do write a definition that classification of journal entries into the respective ledgers is known as posting. Classification or recording of respective journal entries into their respective journals is known as posting. Clear? So this is the second step, classifying. And then third step is summarizing. Summarizing in what way? Summarizing may consist of making a trial balance and then making financial statements so that we can come to a conclusion. So accounting basically consists of three parts. First is recording, then is classifying, then is summarizing. When we are done with all these steps, then we are able to interpret the results. We are able to make the financial statements, which is known as balance sheet, and P&L or income statement. We'll be able to come to a conclusion that, okay, this is the profit our company has earned in the year. This is the balance sheet position of our company over the year. So then we'll be able to come to a conclusion. We will be able to interpret the results thereof. So this is the whole process which is known as accounting. I hope it is clear. So let us go to the notes. So our note says that accounting is the art of recording, classifying, and summarizing in such a manner that financial character and interpreting the results thereof. So we just have to memorize 4 words which are very important: recording, classifying, summarizing, and then interpretation of the results. That is all in accounting. I hope it is clear. Okay, so then we are talking about certain books which I was talking earlier. Then we have certain primary books and secondary books. Just a moment. We have certain kind of books for recording of these transactions, which are primary books and secondary books. So these primary books are generally journal or sales book, cash book, purchase book, etc. These books are known as primary books, books of original entry. There is another word for this which is known as books of original entry. Please do remember these keywords because they do ask these kind of words in the paper. Books of original entry. Books of original entry is journal book, or these are other subsidiary books: sales book, purchase book, cash book. And then after secondary books are our ledger accounts. They would be secondary books. From primary books, we will make entry to the corresponding secondary books. For their in detail, we will discuss these in detail in a later part of this chapter. So as we have gone through the definition of this, recording means all the business transactions of a financial character as evidenced by sales bill, passbook, salary slip are recorded in the books of account. Recording is done in a book called journal. So this would be termed as record. And then classifying. Classifying is concerned with systematic analysis of the recorded data. So, and classified information is called ledger. So we have to go through these 2-3 words only: journal, ledger, and summarizing the data so that it could be presented to the internal as well external users. For summarizing, we'll make the trial balance, and then after we'll make the financial statements, balance sheet, and profit and loss, so that that data could be of use to the internal as well as external users. So that would be summarizing. These are the basic 3 steps which I have already discussed. Then after 2-3 steps are also there which helps in interpretation of the results. So now I'll explain those 3 steps. So these are the 3 steps. That is, first is analyzing. What do we mean by analyzing? Analyzing says that, like for P&L and balance sheet, we'll make a relationship. First of all, we have to make a relationship. We have to establish a relationship between some P&L items and some balance sheet items. So what do we do for establishing a relationship? Generally, we go to ratios, like debtor turnover ratio, current ratio. So if we go to the ratios, then we'll be able to establish a relationship. Then if we establish a relationship, that relationship itself is not sufficient. we have to come to a conclusion. We have to go to the results. To go to the results, we have to interpret. We have to interpret those results. For example, if we go to current ratio, I know you might not know these words. These words may sound very, very unfamiliar to you. I'm just trying to explain you what analyzing, what interpretation is to you. Just remember that there is something like current ratio. Current ratio is equal to current assets divided by current liabilities. So for your knowledge, I'll explain what current asset is and what current liability is. Current assets are all those assets which will be recovered in, which for those payments will be received in 1 year, like stock, like debtors. Generally the payment is received within 1 year. So they will be current assets, very short period of assets. So they are current assets. Same for liabilities, which we have to repay within 1 year. So the division of both these, we can go to current ratio. So if we calculate this current ratio, would it be sufficient? Is it giving us any information? No. Will you be able to derive any meaning out of this information? No. Till we interpret the results, till we come to a conclusion that what do we mean by this current ratio. If current ratio comes out to like 5:1, then we have to use our minds, go to a thorough thinking and come to conclusion, okay, if current ratio is 5:1, then okay, our current assets are very high, then we have to do something about it and make it come to a very decent level. Then that is the interpretation we do. So this is analyzing, and after analyzing, we have to think about it and interpret the results. That would be interpret. I hope it is clear. And then communicating. So communicating means if after making the financial statements, if we don't communicate that to the users of the financial statements, then it doesn't make any sense. We can sit at our home and make the balance sheet. If we don't publish that balance sheet, then our users won't be able to even understand that what are our profits, what is our balance sheet position. So after all this, then we have to communicate this. We have to make it available to our end users. We have to distribute it to our end users. Okay, that would all be included in accounting. So accounting basically generally has 3 steps. First of all, we have to record, then classify, then summarize. After all these 3 are done, then we will analyze it, and then we'll analysis and interpretation. We have to communicate that information, communicate those financial statements to its users. So who would be the users of the financial statements? That would be the question that could be asked. And that must be coming to your mind also, that who will be the user of that financial statements? You, me, everyone would be the user. So first of all, public. Everyone is interested to know what is the present position of Reliance, Ambani's, Adani, Tata's. Everyone is interested to know. So the whole public is interested to know the financial position of an enterprise. So public. Employees will also be interested. Employees will also be interested in knowing that what is the present position, how much the company is doing good, because they also have to secure their future. So they are also interested in knowing what is the position, what is the financial position of the enterprise, of the company they are working in. So public, employees, government is also interested, because government has to collect the taxes. So government is also interested. So, and there are creditors. There are many type of stakeholders who are interested in knowing what is the present position, what is the financial position of a company. So they are the end users. They are the end users of the financial information. So communicating this to the end user. And communicating what? Our financial position. So how do we communicate that financial position? Our financial position is reporting in terms of our financial statements. So financial statements includes our profit and loss and balance sheet, which is known as our accounting report, which after being audited by an auditor, auditing means after checking, after thorough checking by a person, by a chartered accountant, he is known as auditor in this case. So that would be termed as audit report. So we have to communicate this audit report to all our users. So that would compile everything about accounting. So these are the basic steps which would be included in accounting. First of all, we will record, then we will classify, then we will summarize. First, and then another part which includes analyzing, interpretation and communication. I hope now you are getting a basics of accounting, like okay, this is something like accounting. So you just have to know the basics of accounting. Okay, this have to be done, and it's all sorted. It's not a very rocket science. It's a very easy subject. You just have to go with the flow and go with me. It's all sorted. Don't worry about it. So there is another word also, bookkeeping. You must all have heard about bookkeeping. Bookkeeping and accounting. These are two different words. Bookkeeping is just a child of accounting. Bookkeeping is just recording of transactions. Accounting is recording, classifying, summarizing, and then interpretation of the results. So if there comes a difference between, if any statement says, is bookkeeping and accounting the same? No, it's not the same. Bookkeeping is just a subset of accounting. So there are basic differences between both accounting and bookkeeping. We'll directly go to them. So bookkeeping is concerned with only recording of transactions, and accounting is all about summarizing. In summarizing, we have written in short summarizing. It's recording, classifying, summarizing, and then analyzing. So in short, we have written that summarizing of all the transactions. Second difference would be, it is a base of accounting, because first of all we have to do bookkeeping only, recording of transactions only, then only we will do further steps. So it's a base for accounting, and accounting is the language of business. It's a very common term that as there is language for everything, for business also there is a language which is known as accounting. Because on the basis of accounting only, everyone would be, any business enterprise or any owner would be able to their present position, they'll be able to explain how much they're earning. So that is the language any business has to use. So accounting is a language of business. Then third is, it doesn't, financial statements, we don't form financial statements in bookkeeping. As I have explained, we just record the information, nothing more. So no financial statements, no managerial decisions can be taken on this basis. That's but obvious. Now, if we don't have any financial statements, then how can any management take any decision on the basis of some transactions? Like I do have certain transactions like cash to RAM, furniture to cash. What can any management analyze out of these transactions? Nothing. We have to have a balance sheet. We have to have an income statement so that we can analyze some information out of it. Just recording of certain information doesn't give any very major information to anyone. So no managerial decision can be taken on this basis. There is no subfield. Like accounting has certain subfields like financial accounting, management accounting, we'll just discuss them. So, but there are no subfields of bookkeeping. And no financial position can be ascertained. That's but obvious. If financial records can't be made, financial position also can't be ascertained. But all these can be done in accounting. So accounting is a wider sense. Accounting is a wider picture, whereas bookkeeping is just a small subset, just a smaller picture of a very small subset of account. So that's the basic difference between accounting and bookkeeping. So subfields of accounting, like which have been just mentioned, financial accounting, management accounting, they could be asked in the paper like, what do we mean by management accounting or financial accounting? Financial accounting is very simple. Whatever we are doing, like whatever the financial statements are we are making, we are presentation, preparation and interpretation of the financial statements would be termed as financial accounting. And this financial accounting is always historical in nature. You will think why it is historical? Because this accounting happens at the end of the year, after everything is done. After 31st March, we will sit down and make the balance sheet, because everything, all the transactions have already happened, so we can't do much about it. So it's historical in nature, as the transaction have already happened. So we'll make balance sheet and P&L. Everyone must be thinking that what is this balance sheet, what is this P&L, ma'am is using it again and again and again. Don't worry, we'll discuss it in detail. Just go through just have a idea about accounting, just learn, just grasp these words. Okay, there is something like accounting, there is something like P&L, there is something like income statement. Just learn these words, don't worry, we'll discuss them everything in detail, don't worry about it. These are just the words, don't worry. So this is financial accounting. Interpretation and preparation of financial statements. whatever we were doing in accounting, that is financial accounting only. In generally, what is accounting is financial accounting only. Second is management accounting. Management accounting is we need to prepare certain reports for which these reports are prepared so that our managers could derive the meaning, could derive the position. So what do we mean by reports, and what do we mean by like the interpretation of the position? So management accounting says that, for example, any manager would certainly management accounting says that we need to prepare certain reports so that managers can derive information out of those reports. So one day it could happen that our management has to know the budget of our company. Our management needs to know the cash position of our company. So he might call one employee and ask, okay, what is the cash position of our company? Make a cash flow analysis, make a cash projections for the future. So any report which is required by our management so that they could derive any meaning, they could derive any information comes under management accounting. So the preparation of any reports as required by the managers for discharging their function, it is known as management accounting. There could be cash flow analysis, inventory turnover analysis, budgeting, etc. So these could be the things that comes under management accounting. Next is cost accounting. Basically, cost accounting is we have to analyze the cost of a particular project, and to analyze that cost we have to record certain transactions, we have to record certain expenses, and then we have to analyze whether the cost we decided and the cost which actually came is somewhat similar or not. That is overall cost accounting. For example, this pen, I have to calculate the cost of this pen to run the business of this pen. So to do everything so that I can come to the cost of this pen comes under cost account. So it begins with recording of income and expenditure and ends with preparation of periodical statements so that cost could be controlled. Same as financial accounting only. Financial accounting is a bigger picture. It is concerned with the financial position of a company, whereas cost accounting is concerned with controlling cost only, or to calculate the cost of certain products, we go for cost accounting. So cost accounting is a different picture altogether, whereas financial accounting is the overall picture of a financial statement. There are two more accounting ways. One is social responsibility accounting. Like this social responsibility accounting is a very big high these days. You must all have heard about CSR, corporate social responsibility. So that is the term which is generally included in this. We have to see our social cost and the social revenues which we earn. So generally the accounting of CSR comes under this social responsibility accounting. If you haven't heard about CSR, please do go and read. This is an homework. Please go and read about CSR, to which company CSR is applicable, what are the conditions, everything. Please go through it. Like CSR has always been a high topic, so it could be asked in the exam. And next is human resource accounting. Human resource accounting is not applicable in our country. Generally, we don't account for human resources or investment in human resources, so that is not applicable to us. Next is, as we have discussed, users of accounting information. We have already discussed it, but now we will discuss it in detail. Who are the users? First of all, investors, as we have already discussed, whosoever is investing in any company, they need to know the financial position of a company. So investors, employees will also be concerned, leaders, suppliers and creditors, whosoever is supplying any goods to the company, they'll always be interested because they have to take their money back. They have to get their dues clear. So they have to know the financial position of a company. Then customers, government, public, management. Please do cram these words, because generally this kind of questions are asked, like who are the users of the accounting information. So please do by heart these 4, 5, like 8, 9 terms. Please do that. Okay, so this is also a topic, role of accountants in society, but it's not a very major topic, or it's not very much relevant. But I'll just brief you about this. Like, why do we need accountants? Accountants are required for maintenance of books, audits, taxation, accounting, financial advices, and all. It's not very much relevant. Then after we'll go to accounting equation. Next topic is accounting equation. Just a second. This is the basics of accounting. This is the equation on which the whole accounting is based. This equation states that assets will always be equal to liabilities. Please do by heart this definition or this equation. This is the foremost, very most important. This is usually asked. Assets or liability, or in other words we can say that assets equals to liabilities plus equity. Liability and equity are two different points. Liability is our liability to outside world or to outsiders. Outside word doesn't mean like out of India or something. Outsiders just mean outside of our organization. And equity means liability to our owners. Any money invested by our owner in our company only would also be a liability for us. As I have already explained, like if ABC, in ABC company, if A has invested 1 lakh rupees, then that 1 lakh rupees is a liability for ABC company. That company and that A are both different individuals, both different entities. So that would also be a liability for ABC company. So please remember this definition: asset equals to liability plus equity. That is the basic accounting equation. So paper could ask like this also: asset minus equity equals to liability. So this is also correct. So don't fall into the trap that okay, ma'am has told that asset equals to liability plus equity only. They could also like take this side to minus, and then also it would be equal only. So that is also the term that could be asked in the exam. So please do by heart this definition: asset equals to liability plus equity. Okay. So that is the basic definition of accounting equation. Then after we do have certain accounting standards. So what do we mean by accounting standards? Accounting standards are basic guidelines on how to prepare the accounting statements. So these are the guidelines which are universally applicable, and they are compulsory for preparation of any financial statements. For example, if you have to prepare any financial statement, then you have to mandatorily follow every accounting standard whichever is applicable to your company. So it's very mandatory, and you must know these. So these accounting standards. So first of all, compliance of these accounting standards. So who need to comply these accounting standards? Accounting standards needs to be complied by the auditor. Auditor has to report in their accounting books that okay, these accounting standards have been complied with. If any auditor says that okay, accounting standards have not been complied, then it's not a good report. Then it's a qualified report, and that qualified report is not a good report. We can say that. So these accounting standards have to be mandatorily complied, and auditors have to say that in their books that okay, these accounting standards have been complied. Then after, who makes these accounting standards must be the question that must be coming to your mind. These accounting standards are recommended by ICAI, Institute of Chartered Accountant of India, on the advice given by National Financial Reporting Authority, NFRA. NFRA is a body which recommends these. Just a second, I don't know why it's NFRA. NFRA is a body which recommends these accounting standards to center government, which advises these to center government on the recommendation they receives from Institute of Chartered Accountant of India. So three bodies are included in this: Institute of Chartered Accountant of India, ICAI, NFRA, National Financial Reporting Authority, and third is center government. Overall, the responsibilities of center government to issue these guidelines, to issue these accounting standards, but they are recommended and advised by like ICAI and NFR. So in accounting, so every profit and loss statement has to be complied with these accounting standards, and in case they don't comply, there is any deviation, then that deviation has to be disclosed in those financial statements itself. And we have to disclose what? That there is a deviation and why there is a deviation and what is the financial result of these deviations. So three things have to be disclosed. First, there is a deviation. Deviation from which accounting standard is also has to be disclosed. Like in detail, like for example, there is something like AS1, which is disclosure of accounting policy. So if we are unable to disclose any accounting policy, then we will make a disclosure that okay, this is not has been followed, this accounting policy has not been followed. So we will make a complete disclosure that okay, this is the deviation, this is the reason for the deviation, and this is the financial impact of the deviation. So all this has to be mentioned. And then it says the central government has the power to prescribe these accounting standards. And there is also something like director's report. Director's report is also a part of our financial statements only. So that has also to say that okay, our report is in compliance with accounting standards. So financial statement will everywhere say that okay, it's in compliance with accounting standards, and in compliance with accounting standard. We just have to check that okay, it's complying with accounting standard means it is according to the rules and regulations given by the government. So it's a good report, it's a good company. That's the whole picture which is giving, which we can derive out of all this. So the next question that comes to our mind is why these accounting standards have been come? What is the purpose of these accounting standards? If there are no accounting standards, then there will be no uniformity. There has to be some standards on the basis of which financial statements have to be made. If you are making your statement according to your whims and fancies, I on my whims and fancies, then books could never be compared. So for example, if there are two companies working in the same industry, like for example, steel, Tata Steel, Bhushan Steel, or we can say ABC and Steel, and DEF and Steel, we won't take the names of the company, ABC Steel and DEF Steel. So if ABC Steel is using different methods and DEF Steel is using altogether different methods, then how can we compare both of these? It's impossible to compare these. It's impossible to compare their revenues. It's impossible to compare their profits. So both of them has to follow the same standards so that there is uniformity, there is reliability. So these are the basic objectives of the accounting standards: to bring uniformity, reliability, simplification. If everyone is following the same process, then the accounts will be simplified. Then it would be very easy to compare. So there would be simplification also. Then it would obviously prevent frauds and manipulation, because if everyone has to follow some rules and regulations, then the chances of frauds and manipulation will be lessened. Because if there are no rules, then everyone will do fraud. Because there are no rules, there is no rule to caught. But if there are rules, then the fraud could be restricted to some of the extent. So we need to have certain rules and regulations. For those, we have certain accounting standards. And then we come to accounting policies. Accounting policies are the principles of accounting which are adopted by a particular enterprise in preparation of the financial statements. They are certain to a certain enterprise. Everyone will follow different accounting policy. Accounting standards are uniform, but accounting policy will be different for different enterprises. It will be unique to you and unique to me also. I can follow different accounting policy and you can follow different accounting policy. So accounting policies will be unique. So, but everyone has to follow some accounting policy, and they have to disclose that also, which is mandatory under Accounting Standard 1. Accounting Standard 1, which is states disclosure of accounting policy, and it's mandatory for everyone: company, firm, joint stock company, trust, society, everyone. Everyone has to follow this and have to mandatorily disclose their accounting policies. Then, if we are making certain accounting policies, there are three terms which are generally used. First is substance over form, second is materiality, and third is prudence. So prudence in itself will be very clear. If I'll ask any one of you what prudence is to you, so anyone prudence, just pause and write in the comment section what prudence is. So prudence is wiseness, as we all understand by our common understanding. And if you're wise enough, then what will you do? Will you overestimate your revenue? Your answer will be no. If you're wise enough, then will you overestimate your revenue? The answer would be no. Or will you underestimate your expenses? The answer would again be no. So I'll explain this prudence with the help of an example. Then you will never ever forget this in your whole life what prudence is. So what happens is, there is a person known as Ram. Ram is working in Delhi and he is earning 20,000 per month. But his father is a very big businessman. He's saying that please do come back home, please join our family business. Our family business is earning about 1 lakh per month. So if he'll tell his family that he's earning only 20,000 per month, then his family will obviously call him back. So what he does is, one day his father calls him and asks, okay Ram, tell me what is your salary? And then he starts thinking, if he'll say 20,000 per month, then he'll gone. His father will call him back, and then he has to do that family business. And the problem is, his family business is something related to that cow dung only, and he doesn't want to do that. So there is nothing, no work is lesser, but he doesn't want to do that. So what will he do? He starts thinking of a plan, and after thinking for a while, he comes to a conclusion that he will overestimate his revenue. He will overestimate his salary. Instead of 20,000, he said that, Papa, I'm earning 40,000 per month. Now his father is like, okay, 40,000 is a decent amount, about 40% of what I earn, he's also earning, then it's fine. He said 40,000, he thought, okay, let me solve the shorter problem, then we'll think about it in a bigger plan. So it's done. 40,000, he states he overestimated his revenue. Picture doesn't end over here only. Next day his mother called. His mother asked, Beta, what are the expenses? Now he starts thinking about the expenses. Then he starts calculating. 5,000 is the rent, 3,000 is food, 2,000 is traveling, 2,000 is other expense, 3,000 is expense on girlfriend also. Okay, 15,000 expense and 20,000 salary. It means I am just saving 5,000. And if I'll tell my mom that I'm spending 15,000 per month and saving only 5,000, then my mom will never let me stay over here and complete my dreams. They'll definitely call me back. So what he says to his mom, Mom, my expense is only 5,000. Nothing, rent is 2,000 and I don't spend enough on food. I make the food myself only. So no expenses and no other expenses. I walk everywhere. So I don't use any metro, I don't use rickshaws. So like my expense is 5,000-6,000 only. And then his mother is like, okay, 40,000 is the income, 5,000 is the spending. Then his son is saving 35,000. That's a very good amount. So now his whole situation is sorted. But reality is he's saving only 5,000. Under this, he has overestimated his expense, overestimated his revenues and underestimated his expenses. That has given a wrong picture. So that is prudence. If you are overestimating the revenues and underestimating the expenses, then it will give a wrong picture to the users. So as it has given a wrong picture to his mother and father, it will give a wrong picture to the users of the financial statement, which is completely prohibited. So you don't have to do this, and you should never do this. This is completely prohibited as per the accounting standards. You have to show the true and fair view, the correct picture. So this is what we know as prudence. Now you'll never forget what prudence is. Ram will never, Ram would never go out of your mind. So prudence is final. So this is prudence. Next is substance over form. Substance over form says that substance is equally important as form, or substance is more important than form. So what is the substance and what is the form? Substance is the true meaning. And form is legal form. In some cases what happens is you must have given the true picture legally, but it is not true substantially or in true faith. It's not true to the users of the statement. How is it possible? For example, there is a rent of rupees 1 lakh. So expense is 1 lakh only. If instead of rent you are writing commission, then also the net profit will be same. So profit will still be same if you write rent, if you write commission. In both the cases, our financial statement will show the same picture. So legally, you can to some extent say that the picture is in overall it's correct, but it is not showing the true meaning. It's not showing the realities of accounting transaction. So the substance has also been corrected over the legal form. And why it has to be done? Because in rent, in 1 lakh amount, there will be no TDS liability. But if it is the case of commission, then there will be TDS liability. TDS is tax deducted at source. So this is just an example that there could be other liabilities also when you show the expense in some other name. So not just for the legal compliances, the true meaning, the true picture has to be shown to the users. So that is substance over form. And then third is materiality. Materiality is we have to disclose the material information, not the immaterial information. Like there could be sales to thousands of persons. Like I have sold goods of rupees 100 to Ram, 100 to Sham, 50 to Ramu, 60 to Shamu. So I can't do this like sales book. If I'll say sale in the books of accounts and I'll start writing Ram, Sham, this, then my whole financial statements would be 1,000 pages long. And then who will be able to read that? No one. So I have to disclose only the material statements, material transactions. So these are the three things that have to be considered in accounting policies. First of all, the prudence. Second, substance over form. Third would materiality. So these are the basic things we have to keep in mind. This is also a very good question. This could also be asked. They can give 4 options and say which are the considerations which are used in while selection of accounting policy. So just remember the names. So next is change in accounting policy. When can we change the accounting policies? We can make an accounting policy, but there could be some situations when there is a need to change that also. So when can we do that change? So that can be done in the case of change in law, change in accounting standards, or to present a true and fair view. If these 3 are the cases, these 3 are the only cases when we can do a change in our accounting policy. In case of change in law, change in accounting standard, or to present a true and fair view, or to present a better picture, we can do a change in accounting policy, but that has to be disclosed, and any deviation, any financial impact also has to be disclosed. Then comes accounting standards. In our paper, accounting standards don't have like in-depth coverage, so you just have to know the names and the standard, because the question generally asked is what is accounting standard 2, like what it is related to, or they can give the name or ask which is this accounting standard. So we have to by heart these accounting standards. So it is very, very, very necessary. Please do learn all these accounting standards. I'm not giving you the details of these accounting standards because it is not relevant for our exam. So first is accounting standard 1. Accounting standard 1 is disclosure of accounting policies. This has already been discussed above also. First is disclosure of accounting policy. This is very important. This is usually asked. AS1, disclosure of accounting policies. AS2, valuation of inventory. Inventory is stock. Third is cash flow statement. Cash flow statement is it depicts the cash position of a company. So third is cash flow statement. Please do keep on writing this. This is very important for the exam. AS4 is contingencies and events occurring after the balance sheet date. Means if after 31st March any contingencies, any very big transactions happen, so what do we do with these transactions? So that is covered under AS4. AS5 says about net profit or loss for the period. AS6, it has been deleted, it has been merged with AS10. So you don't have to know about AS6. It was earlier about depreciation. So now it has been included in AS10 only. Then AS7, construction contract. AS8, it has been replaced by AS26. AS26, intangible assets. So now AS8 is also not there. AS9, revenue recognition. It is also very important. Generally, it is asked AS9. AS9, revenue recognition. Please do remember this. AS10, it's PPE, property, plant, equipment. Then AS11, foreign exchange. AS12, government grants. Please do keep on writing this. It's about accounting of government's grant or any grants, like any specific grants, journal grants. How do we record these grants? What is the impact on the balance sheet, profit and loss statement? So this AS tells about government grants. Then AS13, investment. Any investments made by any company in short-term assets, long-term assets, that would be included in this AS13. AS14, amalgamation. In journal words, you can say amalgamation is mergers. ABC company merging with BEF company, it's amalgamation. Or takeover, ABC company taking over BEF company. So there could be many terms for this. So for your understanding, you can take amalgamation as merger, merging of two companies or taking over of a company. It's AS14. AS15, exam could ask AS15 because it's about employee benefit. So an exam is also about employee EPFO. So there is a possibility that they could ask AS15. So retirement benefits of employees. Then A16, borrowing. Whatever the money that is borrowed by a company, how do we account that? Borrowing from government, borrowing from financial institutions, from creditors, from any normal individuals. So all those borrowings and the cost, like interest cost, principal amount, how do we record these is included under this A16. Then is A17, segment reporting. Segment reporting is about different segments of a company. Like for example, I could have a business in Delhi, in Calcutta, in Missouri, in Ahmedabad. So there could be different segments and different areas, then geographical locations, then different products also. I could be dealing in sugar, salt, like spices and n number of things. So there could be different segments related to geography, about products. So all those segments has to be reported differently. Like we'll make a different segments and then we'll club all the segment and give a consolidated report. So that's segment reporting. Then 18, AS18. AS18 has always been very important. AS18 is about related party disclosures. Related party disclosures means anything which is related to our company or those like relatives of the company or relatives of the directors. They are usually included in related parties or KMPs, key managerial persons. So if anyone is related to those, then the transactions with any related parties have to be disclosed. It has to be thoroughly disclosed, each and every transaction, because you must be thinking why we are focusing so much on related party. I could be having n number of relatives, so why each transaction have to be disclosed? Because what happens is generally with our relatives, our prices could be lower, or we can sell at a lower prices or purchase at a very higher prices so that our relatives get benefit. So to protect that, we have to disclose that related parties and to say that all the related party transactions are at arm length. Arm length is price at which normal business transactions are conducted. So we have to disclose all the related party transactions. So AS18 is generally very, very important. So do remember it's AS18. Then AS19. AS19 is about leases. Lease or in general terms we can say rent. Hiring hiring a property, hiring any plant and equipment, renting anything comes under leasing. Next is AS20, earning per share. What is the earning that is earned on a single share of a company? How it is calculated, like what is the earning per share right now, what the things are included, what are excluded, all these ifs and buts are done, and then this AS comes into the picture. Then is AS21, consolidated financial statement. Consolidated financial statement is about financial statement of a big company, holding company, and its subsidiaries. Subsidiaries are the companies in which any holding company has more than 15% shareholding. So any holding company having more than 50% holding in any company would be a subsidiary company. So consolidated financial statement would be the financial statement of holding company as well as subsidiary companies. So clubbing them together would be consolidated financial statements. So to make those kind of financial statements, AS21 would come into the picture. Then next would be AS22, taxes on income. Generally, two concepts come over here, DTA, DTL. You just remember these words, you don't have to go into the very depth. DTA, DTL are deferred tax assets, deferred tax liabilities. AS23 is investment in associates. There is also one word called as associate. Other than subsidiaries, there is also provision that we can invest only like about 20%, 15% our share in any company. So if we are investing only up to 20% or we are having control, then that would be associate. So in associate, we don't merge our accounts, but we have to make the disclosures. We have to do certain transactions in the case of associates also. So that would be covered in AS23. Then next is AS24. AS24 is about discontinuing operations. Any operations, any subsection which has been discontinued, that has also been disclosed, and that would be covered under AS24. Then AS25. AS25 is about interim financial reporting. Interim financial reporting is about if we have to report in mid of the year. Like generally we make accounting statements after the end of the year, like for a complete year after 31st March. But there are certain situations when we have to disclose, or certain companies like listed companies, they have to disclose their statements every quarter. So for them, they have to make interim financial statements, middle accounting, like in mid of the year, they have to make financial statements. For all those companies, this AS25 would come into the picture. Then is 26, intangible assets. Intangible assets are all those assets which can't be touched or seen. So these are like goodwill, patents, copyright, so goodwill is your reputation in the market. DIADEMY IAS is having a certain reputation in the market. So that is the goodwill. Patents, like if you discover a certain new technology and you go for a patent of that, then you are the only person who will be the owner of that, who will be having the patent rights over that new innovation. So that is the patent, but you can't see that, right? You can't see the patent. It's not seen. It can't be touched. So that is patent. Copyright is regarding certain artistry works. So if you're writing a novel and you go for the copyright so that no one copies for it, then it's copyright. So these are the intangible assets. So for accounting of these intangible assets, as AS26 come into the picture. Then is AS27. So like similarly, as we have discussed about subsidiaries, associates, there is also a word which is known as joint venture. So what joint venture is? You must have heard about like A company and B company today, like together they make a C company. They both are using their resources and developing a C company. So that is a joint venture. Both A and B together make a new joint venture for a certain transaction. Generally these are made for certain transaction only, and after this transaction is done, then they dismantle this company. So that is a joint venture. Both A and B are using that company. They are using their resources to run that company. So that is a joint venture. Generally it's 50-50 share between both the companies. So that is a joint venture. Then comes AS28, impairment of assets. Impairment of assets generally says that after using an asset for certain years, it has to be impaired. It starts impairing, the values start degrading. So that comes under impairment. So that is included in AS 28. Then AS 29. It's about provision, contingent liabilities and contingent assets. So to recall, like whenever there is any doubt, we have to make a provision. For example, we sold goods of about 1 crore in a particular year, but we are certain that 5 lakh would never be recovered because Ram has already declared bankruptcy, Sham is no more. So we come to conclusion that like 5 lakh would never be recovered. So we make a provision in our books, provision for bad debts, that this will automatically be bad debts. So we make provision for that. So that is provisions. We already sideline some of our money to making that provision, so that if that expense, if that revenue is not recovered, we could use our money from that provision itself. So that is the provision. And other are contingent liabilities and contingent assets. Contingent liability and contingent assets are the assets and liabilities which are not assets and liabilities as on today, but they could be assets and liability in the future. For example, today I have a case with some ABC company which is pending in the lower court. So after a few years, the situation could be I could win the case or I could lose the case. So that is a contingent assets for me. Right now I'll say that I have claimed rupees 5 lakh from ABC company regarding something. If I win the case, then that would be a contingent asset. So I'll disclose that in our books of accounts, contingent asset. That is not asset or liability as on now, but it could be an asset or liability in future. So it depends upon certain circumstances which will happen, will turn into a asset or liability. So that is contingent asset or contingent liability. So for that we have to go to AS 29. We don't have to go to any details of these AS. I'm just giving you a glimpse so that you know, okay, this was something ma'am has told about contingent asset, contingent liability, so that you can be able to remember in the examination hall. Nothing more. You don't have to go into any detail. You don't have to go to Google and read. If you have to read, then I would have explained. So don't worry about it. They won't ask the details of these accounting standards. You just have to know the names. Just remember the names. Then is accounting standard 30. 30 is about financial instruments. Financial instruments, recognition and measures. These all three, 30, 31, 32 are about financial instruments. Then recognition, then presentation and disclosures. Just remember all these accounting standards one by one. Nothing much. After these accounting standards were issued by our accounting standard boards of ICAI, Institute of Chartered Accountant of India. But what happened was, over the years, we started facing a problem that, okay, it was established, they were made by our Indian accountant, they were made by Indian accounting, like ICAI only, Indian Chartered Accountant Institute. So they were not comparable with the financial statement of certain companies which were incorporated in different countries. So we were facing the problem that, okay, our books are not comparable. Other countries are not relying on our books because they are not made according to their standards or international standards. Then our government took a major step, and then they decided that, okay, there is a certain term which is known as IFRS, International Financial Reporting Standards. These are the standards which are globally accepted. So our government decided that, okay, we also have to make certain standards which are somewhat similar to these IFRS, so that our books are also comparable to the international books. So please do remember the definition of this word IFRS. This is very important. International Financial Reporting Standards, IFRS. So these are globally accepted financial reporting standards, and these have been developed by International Accounting Standard Board. Ours have been developed by Accounting Standard Board of ICAI, and they have been developed by International Accounting Standards Board. It is an independent body which has been set up in, which is headquartered in London only. So why we switched from AS to Ind AS? So that these Ind AS could present a better picture, so that they could be reliable, they could be comparable. So we shifted to Ind AS, IFRS. But what happened was, our country is having different conditions, different regulatory conditions, different legal conditions, and different kind of industries. So we can't copy paste each and everything from the international books. We have to make certain modifications and changes according to our circumstances. So what happened was government sat down, they saw all the IFRS and then they make certain modifications, whatever were required according to our conditions, and make a third term which is known as IND AS, Indian Accounting Standards. So a new term came, Indian Accounting Standards, IND AS. IND AS are somewhat or mostly similar to IFRS, but they are not a verbatim of IFRS. Verbatim means just a copy paste. It's not a copy paste of IFRS, but they are somewhat similar to IFRS. So we proceeded with IND AS, Indian Accounting Standards. But there is one more thing, IND AS are not applicable to each and every company. They are not applicable to, because they are very complicated, very huge standards, and they have just been applicable 4-5 years back. So it's very difficult for a company having a turnover of 4-5 lakh only to go to a CA and have a thorough Indian accounting standards. So that is very difficult. So government didn't burden the general public. They said that the listed companies and the company having turnover, having net worth more than 250 crores has to follow IND AS. So it's not mandatory for each and every company, only listed companies and companies having net worth more than 250 crores has to mandatorily follow this IND AS. But IND AS are applicable, and maybe over the years it will be, the government is continuously reducing this limit. Earlier it was 500 crores, now it's 250 crores. So it might happen that over the years it might get reduced to 100 crores or something like that. But right now the situation is listed company and 250 crores. So government hasn't burdened each and every one. It states that only the bigger companies, which we need to compare with international accounting bodies, they had to follow this Indian accounting standards. They are somewhat similar to IFRS only. So for this, we have make a comparable chart of AS and IFRS. Please do remember IFRS also, each and every IFRS. Please do remember the names. The details are not at all required in our exams. IFRS or IND AS are very new. So they might ask the name, they might ask the number. So that is very, very important. If you remember comparably, then it's very easy. Like AS1 is disclosure of accounting policy, and similarly presentation of financial statements. They are somewhat similar only, more or less on the similar terms only. Then AS2 is inventory, AS2 is inventory. IND AS2 is inventory. AS3 is cash flow, 7 is cash flow, 4 is contingencies, 10 is contingencies. So they are somewhat comparable. You just have to remember the numbers. Please do that because it's very, very, very important. IND AS do comes in exam. In many exams, they are directly asking the numbers, what is IND AS 7 about, or what is the number of the cash flow statements. So please do remember the numbers and names. I'm not reading all these. You just have to remember these. Just go through it, please. So for in certain things, we have directly adopted IFRS also, like IFRS 5, and there are IFRS 1, 2, 3, 4, 5, till 16 we have directly adopted IFRS also, and in other cases we have adopted IND AS. So ours is a mix of IND AS and IFRS. So we have included both. And then the next topic is about double entry system. There are two kind of entry system, single entry system and double entry system. Our accounting system follows double accounting system, double entry system. So what is the meaning of double entry system? Double entry system says that every transaction will impact two accounts. One will be debited and another will be credited. So our accounting will impact two accounts. One will be debited and another would be credited. We'll always make a journal entry in like this. Like for example, furniture. If furniture is paid, if furniture is bought in cash, then entry would be furniture account debit to cash. One is debited, another is credited. We'll go through these journal entries one by one and in very detail in the later part. I'm just telling you double entry system. Double entry system is every transaction, every entry impact two accounts. One is debited, another is credited. So the upper one is debited, down one is credited. Every entry impact two accounts, one is debited, another one is credited. So it's not mandatory that both the accounts would be asset or liability, asset, liability, liability. There is no any specification like that. The two accounts could be any one, asset or liability, asset, liability, liability, but there will always be impact on two accounts, double entry system. Okay, so then the next topic is kind of accounts. Kind of accounts. This is also a very important topic, kind of accounts. There are two type of accounts. One is personal account, another is impersonal account. Impersonal is having then two, real, another is nominal. There could be two bifurcation also in many three bifurcations also, personal, real and nominal. So if the question comes like three bifurcations, personal, real and nominal, that is also correct. So don't fall into the trap of that. Personal and impersonal. Impersonal has two subsections, real and nominal. So question could directly ask that there are three kind of accounts, personal, real and nominal. That is also correct. So you can do that also. So personal accounts. Personal accounts, as the name suggests, tells about a person. The person could be any natural person, it could be any artificial person, or it could be any representative person. So there can be three type of person: natural person, artificial person, representative person. So what do we mean by these three terms? Natural persons are Ram, Sham. They are natural persons. So Ram and Sham would be personal accounts. Okay. Then is artificial person, company. Company, any firm. So if entry is in the name of ABC company, BEC company, then this is also personal account. The question might ask like debtors is which kind of account. So we have to know what is the bifurcation, where debtor comes in. So we have to know the details of each and every bifurcation, that where debtors come in, where cash comes in, where outstanding expense comes in. So we have to go through the details so that we do know which kind of account is this. This is a very common question, whether it's a personal, real or nominal. So we have to know, okay. So that is an artificial person, because it might ask like what is ABC and company. ABC company is which kind of account. If we don't know the basics bifurcation between the personal account, then we won't be able to answer. So we have to know that. So artificial person is companies, any firms, that would come under artificial person. Then third is representative person. That is थोड़ा सा tricky. Representative person is anything that represents a person. So debtors. I don't know if we know about debtors, but I'll explain it. I have sold goods of rupees 100 to Ram. Ram is my customer now. So, and Ram hasn't paid me yet. It's not on cash. Ram will pay me in future. So Ram will be a debtor to me. Okay. So anyone who owes me money, from whom I have to take any money, that would be a debtor to me. For example, Abhishek, right? Abhishek. Abhishek has given rupees 100 to his friend Sohan. So he has to take 100 from Sohan. So for Abhishek, Sohan is his debt. He has to take 100 from it. Like if he has sold his goods, like no loan is included in this debtor term. I have just given an example. If Abhishek has sold goods of rupees 100 to Sohan, then Sohan is his debtor, right? So debtor is our customers who are yet to pay us the money. That is debtors. So debtors would be representative of certain persons. So they will be under personal accounts. Does that make sense? Representative persons they represent certain persons. So debtors would represent certain persons. So they would be termed under personal accounts. Same is the case with creditors. Debtors are for sale. Creditors are for purchase. Right? Debtors, creditors. Then comes is honors. For honors, two words comes in picture. Capital, drawing. So if owner is investing any money, then that would be capital. If owner is drawing any money, that would be drawings. As both these accounts depict about honor, they are also representing honors. So they'll also be representative accounts. So debtors, creditors, capital, drawings. The picture doesn't end over here. There are two other important accounts which you have to by heart. They are outstanding expense account. And another one is prepaid expense. You just write both these words. I'll explain them in a minute. After going to real and nominal, then I'll explain why outstanding and prepaid comes over here. Okay, like just for 5 minutes, I will discuss that after 5 minutes. Okay, so I'll just rub all this. So, real and nominal. Real is about assets and nominal is about expenses. Assets means plant, machinery, land, building. All these accounts would be real account. So debtors also come under assets, but they are not real because they represent certain person. So they'll come under personal account. That is an exception. We have to remember the exceptions because journal examination asks about exceptions only. Even though debtors are assets, but they are not real accounts. Make sense? Then nominal. Nominal is about expenses. Expenses of what type? Rent, salary, commission, all kind of expenses do come under nominal accounts. But if these expenses are outstanding, if these expenses are prepaid, then they are not nominal accounts. So why this happens? The question is very genuine, like why this happens? If expenses are nominal accounts, then outstanding expenses are why not nominal? That is a very genuine question. The answer to this is, if we are saying that rent of 1000 rupees is outstanding. Outstanding means it has yet not been paid. It is due means your landlord calls to you and says that, okay, Ram, your rent for this month is due. Please pay for that. But you haven't paid for that. It's outstanding now. It's due. You have to pay that, but you haven't paid it till now, so it's outstanding. So outstanding is related to certain person. Rent is an expense, but rent being outstanding represents a person because now it is related to a person. So it comes under representative accounts. Make sense? Same is the case with prepaid. If the account is salary, so then that is an expense. But if it had already been prepaid, if it had been prepaid to a certain person, then that represents a person. Prepaid means already prepaid, already paid. Like we go for the recharge, prepaid recharge. Prepaid means we recharge in advance, then after we use it for 3 months, 6 months. So that is prepaid. So prepaid and outstanding are part of representative accounts. So they would be termed as personal account. But rent, salary or other kind of expense, it would be nominal accounts. I hope it does make sense. Please remember these by heart. I'll just do one thing. I'll just make a chart of this. Personal, everyone please note that. Real, nominal. Please do this in your notebook, and it's a homework to you all. Please do write everything, whatever comes to your mind over here. Please fill it up and send me back. So there could be any other expense, any other asset, any other personal account which comes to your mind. You might ask which is the category that it will become under. So we can discuss that later on. So now this is your homework that you have to learn, or you have to use your mind. You have to brainstorm and think about another kind of any accounts which could be bifurcated in any of these 3 categories. First of all, make the category wise section, which I had already explained. What are the things that comes under real, nominal and personal, and then try to think about some other accounts which could be bifurcated among these 3. Okay. So that's all for today. The remaining portion would be covered in next class. Stay safe, stay healthy, please read well, and do clear the exam. We'll stay in link, we'll stay in touch. Thank you so much. Have a good day.